investors, welcome back. I'm Christina Steeren with Bullseye Investments, where we help busy professionals create a better financial future through apartment investing without a huge time commitment. A couple of weeks ago, I posted a video titled Start Small, Start Now, and it was about all of the different ways that you could get into real estate investments if you weren't quite ready to jump into syndications. One of the ways I talked about was called a real estate investment trust, and I wanted to take some time today to make a video similar to the one I made comparing real estate and stock options for those of you who were deciding between those, and talk about some of the really big key differences in real estate syndications as compared to real estate investment trusts. There are 7 main things that I want to talk about, so let's get started going through them. All right, the first major difference between a real estate investment trust, or an REIT, as they're commonly shortened to, and a real estate syndication is the number of assets, right? So a real estate investment trust is a publicly traded company on a major exchange platform, generally speaking, and they hold a portfolio for a variety of properties. So it's not just a single property, it's a variety of properties that make up this portfolio. A real estate syndication, on the other hand, you are actually investing in a specific property. So you're going to know the specific details of that property, like where it's located, how many units it has, what the business plan is, what the financial information is, because you're investing in a single property. Number 2, ownership. When you invest in a real estate syndication, you're actually making a direct contribution to the purchase of a very specific property, and that property is generally held in some sort of entity like an LLC. On the other hand, with a real estate investment trust, you are buying shares of a company that owns a portfolio. So they are a little bit different in that sense. Number 3, access to invest. Now, an REIT is housed on one of the major stock exchanges, which means it is very easily accessible for you to place funds in, either directly through a mutual fund or through a stock exchange fund of some sort. While a syndication does generally require you knowing either a sponsor or another passive investor, someone that can connect you with someone who's doing syndications, because in many cases, the rules that govern syndications require that you have a previous relationship with a sponsor. Now, not every single deal is like that. Some accept only accredited investors. So in that case, it's more about knowing who has the deal flow and where it's coming from versus that personal relationship that you and your sponsor have built together. But it is deal specific, and it's a little bit more challenging to get into a syndication if you don't know who to talk to. It is, however, important to note that some syndications do allow you to use your retirement accounts to invest. So that's something you're going to need to discuss with your financial planner to see if you have the appropriate type of retirement account to be able to invest. And it's something that you're going to need to discuss with any sponsors you're interested in working with to make sure that the deals you're interested in do accept those funds. So make sure, if that's something you're interested in, that you're doing your due diligence on that side of things. Number 4 is investment minimums. With syndications, generally the entry barrier is anywhere from $25,000 to $100,000 per opportunity, with the majority of them that we've seen recently falling around the $50,000 minimum. REITs, on the other hand, can have a much lower monetary barrier because they are traded on the public stock exchange. So it just might cost less for a single share in an REIT versus a single opportunity, a buy-in share for a real estate syndication. Number 5 is liquidity. Real estate investment trusts are very liquid. You can buy and sell them at any time. Money placed into a syndication, on the other hand, you're usually locked into a business plan and a hold time. So your money is going to be held for the length of the hold period of the property. You shouldn't expect to get it back sooner. Sometimes it does happen sooner with a refinance, so you're able to get a portion of your initial investment back, but you should always plan on not having access to that initial investment for whatever the hold time is when you are invested in a syndication. Number 6, tax benefits. When you are invested in a syndication, you are part owner of a specific property, which means that you are entitled to part of the tax benefits that any owner of that property is entitled to, mainly depreciation. And that depreciation can be used in a lot of cases to offset other income that you might have. So it's this idea of showing paper losses because of the depreciation or the use of a property over time, while you're still getting cash flow and distribution payments actually paid out to you. A real estate investment trust, on the other hand, you are not entitled to those depreciation benefits because they're actually factored into your dividend payouts already. And those dividend payouts are taxed as ordinary income. So that's just something to keep in mind. All right, the 7th and final thing that I wanted to talk to you about are the returns. In a real estate investment trust, the average annualized rate of return over the past 40 years has been 12.84%. And to give you an idea, the average annualized rate of return in the stock market for the past 40 years, so they take everything and average it out, has been 11.64%. So not a bad return on your investment at all. A real estate syndication, on the other hand, can have up to and upwards of, depending on the opportunity and how it's handled and what happens in the markets, 20% annualized returns. That means in a year, you're making 20% of your initial investment. And what that translates to is over a 5-year hold time, you can double your money in a real estate syndication. Now, that being said, real estate syndications are not for everyone. There are a lot of factors that we discussed today that you need to consider to make sure it is the right fit for you and your investing goals. And real estate investment trusts might be a better fit for you right now, or they might be a better fit for your goals long term. You may also be the sort of person who wants to diversify and have some of their money in a real estate investment trust and some money in a syndication, just for whatever fits your goals and your needs. So take some time to reflect on these. Make sure that you're making the best decision for your investing goals and your investing needs, and reach out to us if you have any questions about real estate syndications, because that's where we focus a lot of our time and our energy, not so much on real estate investment trusts. If you found this video helpful, please feel free to share it with anybody else you know who's looking to get into real estate investing, or hit the like button so that people on the internet know that this video was helpful for you. You can also leave us a comment in the comment box below, or email me directly at my email address, which is in the description of this video. I love answering your questions, so email them to me. And other than that, subscribe to make sure you don't miss any of our new content. We'll talk to you another day. Bye.